Hello guys, I hope you are doing your studies well. Only few days are left in your CA intermediate examination and final both. Many students had approached us for full English video lecture for MTP series 1 and series 2 respectively. So we had tried to add subtitle to the Hindi video, but it doesn't make any sense. We had tried so many times, but it doesn't make any sense, and we believe it doesn't give that clarity to the student because he or she might have to look into the subtitle and not to the core content. So here we are re-recording it in full English language so that you guys can easily understand it and brush up your concept more wisely so that you can use them in your examination. So very good luck. Let's start the discussion of MTP series 1 for CA intermediate advanced accounting. So the first question is case scenario based MCQ based question in which equity share capital is given as a 24 lakh rupees, reserve and surplus journal reserve 20 lakh 50,000, securities premium 7 lakh 50,000, profit and loss account 2 lakh rupees. Both of the three reserves are free reserves for buyback purposes. The infrastructure development reserve is created by through an act or something, so that is why it is not a free reserve. Revaluation reserve is unrealized in nature, so that is why we do not consider it as a reserve for the purpose of buyback. So these three are the reserve that you consider: journal reserve, securities premium, and profit and loss account. The total of these three is 30 lakh, and the equity share capital is 24 lakh. So the total equity you had invested in your business is 24 plus 30, it's 54 lakh rupees. Total equity you had invested in your business is 54 lakh rupees. Shareholder of ABC on the recommendation of their board of directors and so the try to buy back and share. The buyback price is 25. So the buyback price is 25. The share par value of share is 10 rupees. So the loss on buyback is 15 rupees. How I came to the conclusion of 15 rupees? Assume you have a share of rupees 10. You will get the liability of 10, but by paying rupees 25, so there is a loss of 15 rupees per share in case of a buyback to you. So the entry for 15 is when you pass the journal entry for buyback, you should have remembered that you book a loss on buyback by 15 into the number of share you bought back. Then you write off that loss through a profit and loss account or any journal reserve or something with the loss amount of loss on buyback. So the entry is P&L account debit to loss on buyback with rupees 15 into the number of share buyback. So the loss is 15 per share. Okay, you are also required informed that infrastructure development is created to satisfy income tax requirement. We already knew that. You don't have to mention. Okay. Question number 1. What is the maximum number of share to be bought back as per the debt equity ratio? So there are three criteria for the buyback. One of them is debt equity ratio, which says after buyback, post buyback, debt equity should be 2:1. I'm not the one who will teach you the formula or something, so you can put numbers and get your answer. I will be the one who will be discussing with you, get the concept and get the clarity to that. So that is why we are here to know to calculate the number of debt equity ratio. So the provision says the debt equity ratio post buyback, after such buyback, the debt equity ratio should be 2:1. So I write debt equity post buyback should be 2:1. Let X be the number of share bought back. So the debt is 52 lakhs. Let's calculate the equity after buyback if you bought back X number of shares. So currently you have 24 lakh equity, 30 lakhs reserves and surplus. If you bought back X number of share by par value of 10, so 10x share capital would be reduced. Similar and with the same amount of face value, you have to create CRR, capital redemption reserve, with the same amount of face value bought back. So 10x is for share capital reduced, 10x is for CRR, and 15x is for loss on buyback that we had earlier discussed. That the loss on buyback is, since you are paying 25 and the buyback par value of the share is 10, so 25 minus 10 is 15 rupees loss per share. So 15x is loss which you write off eventually through reserves and surplus. So these are the three things that comes with the effect of buyback. So I write debt and equity and the after effect of buyback, which should be equal to 2:1. Then I derive the value of X by interpolation techniques of the equation. I got the answer of 80,000 share. There are various other methods as well to solve this question, but since I want you to understand the basic, the concept, so that is why we start from the scratch, from the basics, right? So we got the answer of 80,000 shares. 80,000 shares are required to be bought back, and the answer is B. Okay. What is the maximum permitted equity as per debt equity ratio test? What is the maximum permitted equity as per the debt equity ratio test? The maximum permitted equity means what is the equity amount that you can write off your losses, CRR or other stuff. So if you bought back 80,000 shares by rupees 10, so 8 lakh of capital is bought back. 54 lakh equity total capital and reserves you have minus 8 lakh of equity, you have 46 left. Minimum equity you have to maintain is 52 lakh rupees of loan divided by 2, that because half of it you have to maintain at least, otherwise you cannot buy back equity shares. So 26 lakh would be the minimum amount of equity that you have to maintain post buyback. 46 lakhs will be comes when you bought back 80,000 shares of rupees 10 each. So you have only 20 lakh of balances left for CRR, for loss on buyback and other stuff. So what is the maximum permitted equity as per the debt equity ratio test is 20 lakh. What will the future equity shareholding fund if a company buyback share as a result of debt equity? The future equity would be the 46 lakhs, since you have 54 lakh of equity and 80,000 of rupees 10 each you bought back. The 46 lakh will be left behind. The future equity will be 46 lakh. What is the maximum number of share that can be buyback as per the resource test? So you have 54 lakh of equity, 25% of maximum as per the resource test can be bought back. So this is the amount of buyback divided by the buyback price, you get the number of share that can be buyback as per the resource test, which comes out to be 54,000. I hope the whole concept got cleared in your head with respect to that phenomena. Question number 2. RTS, the company, is engaged in the business of manufacturing of urea, has set up a business in a designated backward area, which entitled the company to receive from the government of India a subsidy of 20% of the cost of investment of manufacturing of equipment component. The company has contract with the Indian Railway for a brake component, which is structured such that the company's obligation to deliver the component to the railway stockyard, while the delivery term are X work. Delivery terms are X work. The company is responsible for engaging a transporter for delivery. The railway send an order for the defined quantity. The company manufacture the required quantity and inform the railway for the carrying out of inspection. Railway representative visit the company's factory and inspect the component, mark each component with the quality sticker check. Goods once inspected by railway are marked with a hologram sticker to earmark for delivery and identification by the customer when they are delivered to the customer location. The company raises an invoice once it dispatched the goods. Okay. So first thing is that the company received a government grant of 20% of the cost of investment. Let us recall the provision of accounting standard 12 with respect to the government grant. It says the government grant is a promoter contribution grant when it is in the nature of investment into the capital. For example, you are planning to invest some amount in some backward area, but you are afraid for the amount. The government has set up an initiative, come and invest here so that our people grow, the overall locality grow. We will also gonna invest into your capital of something of X amount. So that investment that the government invests without recalling it is kind of a promoter contribution grant, is a kind of an investment that government put without having put you an obligation to repay or recall it. It is called as a promotion contribution grant. The accounting for it is it should be transferred to the capital reserve. So the journal entry you're gonna pass for the promoter contribution grant is bank account debit to capital reserve. So this is the point for the promoter contribution grant. The another thing is the company has an agreement with the railway where it says it's an agreement of X works. The X works denote it is a term used in the industry where the contracts are eventually made. The term denote that the obligation of the buyer is only restricted to the to manufacturing of the product and placing it to the desired location. That is the wholesome obligation of the buyer of the seller, sorry, of the seller. That is a wholesome obligation with respect to that seller. Now the buyer has to pick up those goods and deliver accordingly. So here the railway send an order for the defined quantity, company manufacture it, and the railway official comes and inspect and put an hologram sticker on the goods inspected. So once the railway official put an hologram sticker on those inspected goods, now the railway is obliged to take the delivery because they have accepted the quality. They have already given the quantity, defined quantity for the goods to be manufactured, and once the hologram is put on them, they have inspected and agreed to the quality standard of the company. So the company's obligation stops when the railway official puts an hologram sticker and accepted the quality of the product manufacturer. So the company can book revenue once it is delivered, when its significant risk and reward with respect to those goods are transferred to the railway authority, and once the railway authority put an hologram sticker on them, then it means railway authority had accepted that they're gonna accept the quantity, and it is as per the quality standard of the railway. So company can book revenue when the railway or the representative check and put an hologram sticker on that. The management of RTS is under discussion with the auditor of the company with respect to accounting of a critical matter as regard its accounting with recent subsequent with respect to the subsequent events. The event after the reporting period, they have been checking as to which one of the following event after the reporting period provide evidence of condition that existed at the end of the reporting period. So they are asking basically from 1 to 5 which of the following event is an adjusting event or non-adjusting event as per accounting standard 4. Let me recall you some basic provisions of accounting standard 4. Accounting standard 4 says there are some event when you finalize your books of accounts on 31st of March, it not get signed, it not get okay with respect to all other aspect. There are some points that you as an auditor or you as in management of the company is in dilemma. What will be the treatment, what will be the ultimately impact of these unsettled transactions? So once the time period lapses, you pass on month by month, some events or some evidences appear subsequently that gives you evidences that these conditions are actually existed on the balance sheet date. For example, you filed a lawsuit, yeah, or someone filed a lawsuit against you, but you are into a dilemma whether this lawsuit will give me an obligation to pay or an obligation to pay damages or something. So auditor is also into the dilemma and you are also into the dilemma. Although there are legal advices are there, but still there is no defined anything of such amount. The legal expert can give you the estimate, can give you the the possible outcome of the situation, but certainty. You cannot give certainty to you that this will be the outcome. So once the time passes, you get the evidence that yes, claim has been settled and the claim amount is 2 lakh rupees that your company has to pay. So the event that had occurred after the March, that gives you an evidence that the claim of rupees 2 lakhs, since the lawsuit was in existence on 31st of March, so that lawsuit that you have paid, the damage that you have paid for rupees 2 lakh gives you an evidence that this condition for the lawsuit is existed on the balance sheet date. The only this is the only things that comes under the accounting standard for event occurring after the balance sheet date. So the very first point is nationalization or privatization by the government. So if the government nationalize or privatize the railway sector, it doesn't affect your company at all. It is not an event occurring after balance sheet date. For example, 31st of March is there and the government on 5th of April privatized the railway sector. So it doesn't affect you. It doesn't give an evidence that these are the conditions existed at the balance sheet date, or if it existed, then you have not accounted for, you are not required to. Out of the court settlement of a legal claim. So the legal claim once settled out of the court, it gives an evidence that the legal claim is existed or was existed at on 31st of March for your balance sheet, and you have to account for in your books of accounts while finalizing that balance sheet on 31st of March. The right issue of equity shares. Right issue of equity share. So if you are on 10th of April issue a right issue for the shareholder of your existing shareholder, it doesn't give any evidences that the right issue might have been come on 31st of March. It doesn't give any evidences. So the right issue is an unadjusting event. Nationalization is also an unadjusting event. Strike by the workforce. If the workforce strike, if the workforce in your organization strike on 5th of April or May or June or any date before the approval of accounts, it doesn't give any evidences that strike could have happen on 31st of March. It doesn't give any evidences. So the strike by workforce is also an non-adjusting event. Announcing a plan to continue an operation, it is also doesn't give any rise to the event to the evidences that existed at the balance sheet date. Hence it is also a non-adjusting event. But one thing you should always kept in mind, that if any event that had happened, if affect going concern of the entity, then it is always a adjusting event, because once the going concern assumption is inappropriate for your organization, you have to prepare your balance sheet on liquidated basis. So this event, if trigger going concern, then it would be an adjusting event. Okay. The company received a grant of 8 crore from the government of India for setting up a factory in backward area. Out of this grant, the company distributed 2 crores as a dividend. Is it right to do? Government gave you 8 crore because you came to the backward area and invested into a factory or something, but you distributed 2 crores rupees out of that fund to your shareholder, to your owners. It is wrong. It is not wrong utilization of funds. That the 2 crore distribution as a dividend is not a right act, it's a wrong act. The company also received a land free of cost from the state government, but it has not recorded this at all in the books as no money has been spent. So if any fixed assets is received with free of cost, so the AS 12 says you have to record it in on a nominal value basis, because the asset is now yours. If you hadn't record that transaction into your books of account, then this asset that is into your name now will not appear into your books. So the standard says you have to record it into your books of account by a nominal amount, say rupees 100, but you have to record it, right? So RTS has a subsidiary, LPP Media Creation Limited, an advertising agency which prepare and publish advertisement in newspaper on behalf of its client. Okay. So the key point is LPP prepare and publish advertisement in newspaper. So the key point, why the key point is prepare and publish advertisement in newspaper, because it determine the agent and principal relationship of LPP Media with respect to their customer. So let us suppose, let us suppose an example. I am being a teacher. I ask someone, a social media influencer, let's say, or a social media marketing company, to please advertise my business into the social media sector, be it YouTube, Instagram, LinkedIn, or anywhere else. Now they give me an offer of rupees 10,000 per month, in which they're gonna prepare my pamphlet, they're gonna prepare my snapshot of my video, shots of my video, and distribute into the social network accordingly. So these are the services I am getting, and these are the services that they are giving me, and they are charging 10,000 rupees for that. It is not like they are giving me an opportunity to meet with the Instagram influencer or YouTube influencer, so that I and that influencer can have a business and they get the commission. If that is the scenario, then that agency is acting as an agent, not as a principal, because the main services is provided by that service provider. They are only responsible for meeting of client, and they are not responsible for the service providing. But in the first case, they are responsible for the services. They are doing it by their own. So there is a principal. They act as a principal into that transaction, and they can book the revenue on gross basis, not on net basis. In the same scenario here, LPP Media prepare and publish advertisement in different newspapers. Let's say I go to the LPP Media and advertise my coaching center into different newspaper. LPP Media prepares the pamphlets and other things and publish into various newspapers, so that you guys can reach me out. So here LPP Media actually act as a principal, not as an agent. So since they are acting as a principal, they can book revenue on gross basis, not on net basis. Okay. So based on the above information, answer the following. When should RTS Limited recognize revenue as per the accounting standard notified under a company's accounting standard rule? What would be your answer be different if inspection is normally known to lead to no quality rejection? Okay, so revenue should be booked when inspection is done, and it will not change our the assessment of revenue, even if the past practices or the past says there is no defect in the goods manufactured. There is the quality that RTS Limited meet is very well to the known to the railway authorities. So it will not differ our answer, because at the end of the day, the RTS Limited has an obligation to provide quality inspection to the railway, and give the quantity as ordered by the railway and produce that quantity as well. So once the railway authorities comes and inspect and put an hologram sticker on that goods produced, then RTS Limited will be relieved from its obligation, and then RTS can book revenue. So the option is B. Okay. In respect of LPP, how should the revenue be recognized as per the accounting standards? Since we have already discussed, LPP is the principal, so the revenue should be recognized on gross income basis. Revenue should be recognized on gross income basis through media, preparation of advertisement material, and gross amount of payment. Number three, please guide the management of RTS as to which one of the following event is provide evidence of a condition that existing on the balance sheet date. It means which one of the event is adjusting event per se. So we have discussed the claim of legal claim. The point of legal claim is an adjusting event. Please guide regarding the accounting treatment of accounting standard 12. Distribution of dividend is correct? No. Distribution of dividend out of grant is incorrect? Yes. In the second case, recording land in the books of account is correct? No. No. Recording land, non-recording of land is also incorrect. So the correct answer is distribution of dividend out of grant is incorrect. That distribution of 2 crore grant is incorrect, and in the second case land should be recorded in the books of account at nominal value. Question number 3. Mars Limited is a manufacturing enterprise which is starting a new manufacturing plant at X village. It has commenced construction of the plant on 1st of April 23 and has incurred the following expenditure. It has acquired land for installing plant for rupees 50 lakhs. So this is the question pertaining to accounting standard 10. And let us recall first what are the requirement of accounting standard 10 and what are the things that get capitalized and what are the things that get charged to the profit and loss account. So the wholesome concept, if in every accounting standard, if I conclude with respect to the AS2, AS10, AS26, intangible, PP or inventory, any expenditure that you incurred for the activity that is required to get the asset ready into the condition or location as intended by management will get capitalized into the cost of asset. All other costs will charge to the P&L account. This is the most simple rule that follow throughout the accounting standard. If any activity is required to get the asset ready into that condition or location as intended by management, and whatever the cost incurred for that activity will be charged will be added to the cost of asset, should be directly attributable cost and added to the cost of asset. Other costs are charged to the P&L account, right? So if I bought a land for installing plant, obviously it will get capitalized as rupees 50 lakh. It incurred 35 lakh for material and direct labor cost for developing the plant. The 35 lakh cost is required for the development of the plant, which is the condition and location of the plant as intended by management. Hence, it will also get capitalized. The company incurred 10 lakh for head office expense at New Delhi, which include rent, employee cost, maintenance expenditure. The head office cost of rent, of employment cost or electricity cost is not required or not done on the activities that are required to get the asset ready as intended by management. Hence, the cost of 10 lakh will charge to the profit and loss account and will not get capitalized. The company borrowed 25 lakh for the construction of plant at 12% per annum. This is the specific borrowing, guys. This is the specific borrowing. They said they borrowed for the plant per annum on 1st of April 23. Director Finance of the company incurred travel and meeting expense amounting to 5 lakh during the year for arranging this loan. So the amount of director traveling is charged to profit and loss account. It is not a borrowing cost that incurred for the borrowing. So this is not the borrowing cost. It will get charged to the profit and loss account, and 25 lakh of borrowing is a specific borrowing. The whole period borrowing cost will get capitalized into the asset, not the specific period cost which is related to the from the date when expenditure start incurring into the asset. The whole period cost will get capitalized into the asset as the borrowing cost rules. On 1st of November 23, the construction activity of the plant were interrupted as local people along with the activists have raised issue relating to the environmental impact of plant being constructed. Due to agitation, the construction activity came to standstill for 3 months. So let us recall the accounting standard 16 borrowing cost rule. If the suspension is required activity for the development of the plant or the development of the asset, then the suspended period borrowing cost will get capitalized, will not suspended. For example, if you are constructing a bridge into on a river, and you know when the water level rising up, the construction activity has to stop. And so this activity is required, the suspension is required for the construction of that bridge. So the suspension period borrowing cost will get capitalized, it will not get suspended. But on the other hand, the strike of the labor force is not required for the development of the plant, right? So this suspension will hold the borrowing cost for the capitalization. This is a suspension of borrowing cost for capitalization, and you will not capitalize the borrowing cost pertaining to that period of any specific or general, or any borrowing cost will not get capitalized for that suspended period for that amount of for that construction of plant. So 1st of November, the local people interrupted the activity, and with the help of government, the agitation was over by 28th of February. So November, December, January, February, 4 months of the period are considered as a suspended period, and the borrowing cost of 4 months will not get capitalized. So we had taken the loan on 1st of April. Out of 12 months, 4 month period will not get capitalized. 4 month period of borrowing cost will not get capitalized. Only 8 month period of borrowing cost will get capitalized, and 25 lakh at 12% for 8 months is 2 lakh will get capitalized. I hope you can recall the concept and apply it accordingly. Acha. Now, however, to balance the impact of the environment, government ordered the company to install certain devices for which the company had to incur 6 lakh in March 24. So 6 lakhs we had to incur for the environmental impact. That amount of 6 lakhs is required, so the activity of environmental, the changes in the plant can be done, and so that plant can do or perform according to the management intention. Hence the 6 lakh is a directly attributable cost which get capitalized into the plant. So 6 lakh get capitalized into the plant. The rate of depreciation is 10%. Which of the following expense cannot be included in the cost of the plant? It's a head office expense. Head office expense are charged to profit and loss account. How much amount of borrowing cost can be capitalized with the plant? We have already calculated it. 2 lakh rupees is the borrowing cost will get capitalized into the plant. The cost of plant on 31st of March 24 will be, so let us add 50 lakh plus 35 lakh, 50 plus 35 plus 2, 87 plus 6 lakh rupees of environmental damage, 93 lakh rupees will be the cost of plant. Amount of depreciation to be charged. So 93 lakh is the cost of plant, and the plant is not get ready. If the plant is not ready for intended use, you will not start charging depreciation. When you will start charging depreciation? When the plant is ready for use, or can say is in the condition or location as intended by management. And the moment the plant is ready on that state, the capitalization stop and the depreciation start, because now you have ready the plant according to your intention, according to the use that you want from that plant, and then you start using the plant, and the cost appearing in the profit and loss account accordingly, and you start capitalizing cost into that plant when this plant is ready for use. So now we in this question we have not given any data regarding the completion, so the depreciation is nil, right? Let us come to question number 4. P Limited has 60% voting right in Q Limited. Okay, so there is a diagram of the question. P Limited has 60% voting right in Q Limited. Q Limited has 20% voting right in R Limited, and P Limited has 14% voting right in R Limited by its own. So as per accounting standard 18, you know guys, as per accounting standard 18, the indirect relation can only be survive in case of a subsidiary. Subsidiary is the only, we say subsidiary is a boat, subsidiary is a bridge, which so that holding can travel, if it can travel to the another entity. If this entity is not a subsidiary, then this is not a bridge. So P Limited cannot travel to R Limited, but here P Limited hold 60% in Q Limited. So Q Limited is a subsidiary to P Limited. This is act as a bridge. So the bridge can carry P Limited to the R Limited. So P Limited ultimately a related party to R Limited. And since it also holding 14%, which is also accounted as an equity method as per accounting standard 23. For which method you can apply for P and Q? You apply AS21 full consolidation method where minority with 40%, and for P and R you apply AS23 equity method, right? So is P and Q are related? Yes, P and Q are related. Q and R related? Yes. P and R are also related because Q is subsidiary which act as a bridge between P and R. I hope you can remember. The only who can act as a bridge? Only subsidiary can act as a bridge, because accounting standard 18 says the indirect relation can only be made by the help of subsidiary, right? So while preparing financial statement of P Limited, which entity would you disclose as a related party with reference to AS 18? You are required for P Limited. So for P Limited, Q and R both are related party. Okay, a machinery was given on 3-year lease by a dealer of the machine equal annual rental to yield a 20% profit margin on cost of the machine, which is 3 lakh. Economic life of the machine is 5 year. Estimated output of the machinery is 5 year as follows. Year 1 50,000, year 2 60. These are the output. So basically the machine price is 3 lakh where you can add margin of 20%. So the total price of the machine is this. The total output a machine can produce is this, which comes out to be 3 lakh. So you divide the amount of price with 3 lakh units, and the lessee will use the 1,50,000 units within 3 years period. So you charge proportionate rent of 1,50,000 unit from the lessee, which comes out to be 1,80,000. You have to charge equal rental for 3-year period. So this is the rental for total 3-year period. We divide it by 3 and get 60,000 per annum for the lease rent that you charge as a lessor from the lessee, 60,000. What will be the impact on LER, lease equalization reserve? So in case of a lessee, if I talk about lessee, pay the rental of 60,000 but distribute 1,80,000 in the ratio of 5:6:4, because lessee is deriving benefit in the ratio of 5:6:4. So when the lessee derived the benefit into 5:6:4, the expense got charged to the P&L account is 6 for 10 15. Okay, 1,80,000 divided by 15 into 5. The first year rental is 60,000 and you made payment of 60,000, no issue at all. The second year rental is divided by 5 into 6. Second year rental you charge to 72,000. For second year you pass an entry P&L account or lease rental, since it is an operating lease, 72,000 to bank. Since you made payment of 60,000, you made credit to LER 12,000. This LER will get reversed in the third year when the charge would be onto the P&L account divided by 6 into 4, 48,000. In the third year, you charge P&L account debit 48,000, LER debit 12,000 to bank 60,000. So this LER that is created in the second year will get reversed in the third year. So why not LER created in the first year itself? Because the first year rental, if you distribute the 1,80,000 into 5:6:4, the first year rental is itself 60,000. So P&L account debit 60,000 to bank 60,000. That's why LER is not created in the first year. Okay, I hope you remember the concept. Question number 6. A process of reconstruction which is carried out without liquidating the company and forming a new company, it's called internal reconstruction. When you internally reconstruct your organization, reduction of share capital, you join hand in front of a creditor, please waive our loan, waive our debt. So this is called the process of internal reconstruction, when you are internally reconstructing your organization without liquidating it. It is called internal reconstruction. So we had already concluded our MCQ part and we are now coming to descriptive question. The very first question is with from accounting standard 13. Accounting standard 13 is applied from the investor point of view, not from the issuer point of view. So if you had invested into share X limited share, then you apply accounting standard 13 into your books of account, right? So on 1st of April 24, Mr. Zoom had an opening balance of 1,000 equity share of P Limited of for rupees 1,20,000. So once upon a time, Mr. Zoom had purchased 1,000 equity share for 1,20,000. So this will now coming as an opening balance of 1,000 share as 1,20,000. Okay. Now On 5th of April 24, he further purchased 200 come right basis for 135 each. So this 135 include two elements. So come right means, see, when the company announced right, let the share is quoted at rupees 1000 into the stock market, right? Now the company announced right. Company says we are going for a right issue which will be announced on this date. The moment this trigger into the market respond as the now the share hold the share valuation and a valuation that is attracted toward the right, because the holder of the share will now get two things, the shares and a right to get more share at a discounted price. So the to this due to this second right, due to this second right asset, the share price got rise, and it will eventually include the element of right that is now attached to the that share as in warrant, right? So this 135 is include two elements, the share and the amount of right that the holder will get eventually to get the share at a discounted price. So this 135 include two things. One is share and another is right. On 8th of April 24, the director of P Limited announced right issue in the ratio of 1:6. So the Mr. Zoom has 1000 share plus he purchased 1200 share, 1:6 comes out to be 200 shares, right? So opening balance is 1000, 1,20,000. He purchased 200 share at 135. This comes out to be 27,000. Now this 27,000 has two elements. One is share. He purchased for two things. One is share and one is right. Right as in right to get the additional share at a discounted price. He also paid for that amount in that 27,000. Okay. Now Mr. Zoom waived off 100% of his entitlement of the right issue in favor of Mr. X at a rate of 20 each for 4,000. So if 20 each he sell his entitlement to right, and he has 200 right entitlement, so 200 into 20 he'll get 4,000 from that person to whom he sold his entitlement. All of the share held by Mr. Zoom are on come right basis, and total market price X right of all the share after declaration of right got reduced by 3,400. So after the right, the share price has fallen. Why the share price has fallen? Because the market gone up by the announcement of right. Now right has settled, so the share price gone down. So that is why there are three conditions attached to the treatment of right. If three of them satisfied, the treatment would be different. If any of them would not be satisfied, the treatment would be different. What are the three conditions? Number one, share are bought come right basis, which is satisfied here. Number two, rights are renounced, which is satisfied here. Number three, the share price has fallen on X right basis, which is satisfied here, which is 3,400. So the share price got increased with the announcement and got fallen by 3,400 when the right got settled. So the impact of right on that share price is 34. With respect to Mr. Zoom, he paid 27,000, which include the amount of right, yani ki right that means right is included in the debit side. Now he'll getting 4,000 by the sale of right. The 4,000 had two parts. One is the recovery of right, called known as 3,400, or quantifiably the amount of 4,000 include 3,400 as a recovery of right, which he already paid in 27,000, and another 600 is the income from sale of right, which transfer to the profit and loss account. That is why 3,400 as a cost of recovery of investment is coming as a credit side of the investment axis, and 600 is transferred to the profit and loss account. Now if I ask from you, what would be the amount, what would be the net cost that Mr. Zoom has? So is 1,27,20,000 plus 27,000 minus the recovery of cost that he had made by the sale of right is 3,400. So 1,20,000 plus 27,000 minus 3,400 divided by number of share 1,200 is the per unit cost of share for Mr. Zoom. Now Mr. Zoom sold 350 share for 140 each. Selling price is sale proceeds is 49,000. Per unit cost is 119.66 into 350 share. This will be the cost 41,883, and he sold this for 49,000. He has a gain. He has a gain, guys, 717. He has a gain of 7,117. So it will come to the profit and loss account. Balance is the cost of investment. He has now 850 share, costing rupees 119.66. Market price of the share are 140, which is way too higher. Sorry, 125, which is way too higher than the cost. We value our investment, current investments more specifically, on cost or market price, whichever is lower. Cost is 119.66 bar and the market price is 125, whichever is lower comes out to be 119.66. Hence the investment that carried at cost 850 into 119.66 comes out to be 101717. Okay. Okay, I hope this point get clear. Now the second question is with respect to the cash flow statement. The following information were extracted from the books of A Limited for the year ended 31st of March 2025. This is the cash flow on a pointer based. Cash flow question asked in a variety of way. They can give you cash account, they can give you balance sheet only, they can give you balance sheet and P&L account, and they can give you the pointer base. This is the pointer based question. It is so simple to solve the cash flow on pointer base. You have to just make sure 2 to 3 things. Number one is each and every point has a treatment. So if there is a cash flow attached, so you have to pick the point and treat it accordingly into the operating, investing or financing activity. Number two is the most crucial point that you have to remember. If any point has an opening or closing balance, you have to prepare a ledger for it. The moment you prepare the ledger, you got the movement of cash in bank and you put that movement into your cash flow statement, your cash flow will get tallied. If any of you guys try to solve and had any doubt, you can reach me out. I'll figure it out and provide you the more depth understanding of that question. But we are currently discussing on each and every point and what will the treatment of that point. Okay, so the net profit before taking into account of income tax and after taking account the following item was 60 lakh. Many students have got confused with that statement, so please read it very carefully. They are saying the net profit of rupees 60 lakh is before income tax, that is mean it is PBT, and after taking into A to E. So the A to E, only A to E is adjusted in that 60 lakh, not any other item. So if you came across in the below point of any item that you deem fit of charging to the profit and loss account, which is not coming here, it is not adjusted into 60 lakh, and you will not get you will not adjust it into the amount of PBT. Only items with respect to the A to E are adjusted in 60 lakh. Okay, so the first point is depreciation. Depreciation is a non-cash item or non-operating as well. You will add it into operating activity. Discount on issue of debenture is also a non-cash item. You will add it into operating activity. Interest on debenture paid 8,70,000. If it is paid, then it must be charged to the profit and loss account, because it is saying that 60 lakh after charging these items. So you have to add 8,70,000 in operating activity and deduct it from financing activity. Investment with a book value of 7 lakhs sold for 7,50,000. 7,50,000 is proceed from investment. Sale of investment comes into the investment activity category, and 50,000 gain would increase your profit. Now you have to nullify its impact, so you have to deduct 50,000 from PBT of rupees 60 lakh. Interest received on investment 1,40,000. It will deduct from operating activity and add it to investing activity. Income tax paid during the year 25,60,000, which is your operating activity. You will deduct it from your operating activity cash flow. Company issue 1,20,000 equity share of rupees 10 each at a premium of 20%. So 10 plus at rupees 12. So into 1,20,000. 1,20,000 into 12. 14,40,000 as a sale issue from sale proceed comes into financing activity as you issued share and borrowed fund, raise fund. 40,000 9% preference share of rupees 10 each were redeemed on 31st of March 25 at a premium of 5%. So 40,000 into 105 from financing activity will get deducted from the financing activity. Dividend paid during the year amounted to rupees 22 lakh. Since dividend paid is on the amount you had raised by issue of equity share, so dividend pays it also financing activity, because issue of equity share is a financing activity. Hence the amount of 22 lakh get deducted from financing activity. A plant costing rupees 14 lakh was purchased in part exchange for an old plant on 1st of January. The book value of the old plant was 16 lakh, but the vendor took over the old plant at a value of 12 lakh only. The balance amount was paid to vendor through check on 30 March 2025. So now you have come to a doubt. Many students ask that the loss on the exchange would be debited to the profit and loss account, or let's say gain. So why don't we treat that gain or loss into the PBT that we are created into the operating activity? The answer is A to E. It is that gain or loss is not listed on A to E, and you have provided only A to E points are adjusted in 60 lakhs. So that is why we are not gonna adjust the gain or loss associated with that treatment, right? So the only cash flow you had is you had purchased a plant and give the old plant for 12 lakh. You pay more 2 lakh rupees for the purchase of plant. So 2 lakh will be deducted in investing activity. Company decide to value its inventory at cost, whereas previously practice was to value inventory at cost less 10%. The inventory according to the books of March 25 was 29 lakh 52,000, cost less 10%. For March 24, the correct inventory was correctly valued at 27 lakhs. So you have to revalue your inventory of 29 lakh 52,000, which comes out to be the impact of 3 lakh 28,000. How do I calculate 3 lakh 28,000? 29 lakh 52,000 is 0.9 because 10% is less. So what would be the impact of 0.1? It's 3 lakh 28,000. So from 3 lakh, you increase your closing stock by 3 lakh 20,000. Ultimately, your profit got increased by 3 lakh 28,000. So you have to add it back to 3 lakh to profit and adjust the value with respect to your inventory as well. Now the main thing is, if you forget to adjust this point for point number 7, then your cash flow will also tell you, because with respect to that point there is no inflow or outflow of cash. The change in value of inventory will not give you cash, will not take cash from you, and this point doesn't have an impact on cash flow. But ICAI give marks to that point, so you have to provide the presentation of adjustment of inventory into the operating activity and correspondingly into inventory. How do you present into inventory? So the value of 29 lakh 52,000 will erase from your mind now, because you have already adjusted 3 lakh 28,000. So that now the revised value for March 25 inventory is 32 lakh 80,000, and the opening stock value is 27 lakhs. So the difference between these two will get adjusting in operating activity as a change in working capital. I hope you guys can remember or retain the points. If you guys feel any doubt with respect to cash flow or any of the point, you can discuss with me. You have all the sources, my contact number, telegram, email, or the comment section is open for you. You can guys contact me and discuss your doubt freely. Coming to the next question, question number 2. The following are the extract of balance sheet of P Limited and subsidiary Q Limited as on 31st of March 2024. Okay. So it is a consolidation question, I believe. Yeah. On 1st of April 23, profit and loss of Q Limited show the credit balance of 32,000, and equipment was revalued by P Limited 20% above its book value of 4 lakh, but no adjustment affected in the books of Q Limited. And they had purchased investment on April 23. This is the most simplest question of consolidation. So we had prepared a number line. Oh, we had already prepared a cash flow statement as well. You guys can try, you can also solve it, no problem at all. I'll show you the impact of inventory. This is the impact of inventory, increase in stock, and for the change in inventory, I take 27 lakh and 32 lakh 80,000, which comes out to be 5 lakh 80,000, right? Okay, so consolidation, let's come to the consolidation part. This is the consolidation answer. On 1st of April 23, this is your date of acquisition. You have reserve of 32,000. 31st of March 24 is the date of consolidation. The closing reserves are 80,000 for Q Limited. Q Limited is the subsidiary. 80,000 is the closing reserve. You have earned from 32 to 80, 48,000. Since there is no appropriation given in this question like dividend, bonus, I have not prepared reserve and surplus account. Otherwise, I'm going to prepare reserve and surplus account and determine the correct profit earned. We assume that you earned profit evenly throughout the year, so we can distribute profit accordingly. But here, since the date of acquisition is April, there is no need to distribute profit. Consider that date as a Lakshman Rekha. Consider this date as a Lakshman Rekha. Every profit earned till date, this date, every profit earned till date is a pre-acquisition profit, because you are not existed at this point of time. You came into picture on 1st of April 23. How can you claim that these profits are earned by you? You are not available in this time. You came into picture on 1st of April 23. So the profit earned after that, this period, the profit earned after that is the post acquisition period that you earned, because you came into the picture on 1st of April 23. So this is the Lakshman Rekha you have. Every profit earned on that date or up to 1st of April 23 will be the pre-acquisition profit for you, and post that will be the post-acquisition profit for you. So your reserve standing to rupees 32,000 when you bought Q Limited. So 32,000 is not your profit. You bought it. It's not your profit. You are not there when 32,000 was earned. So 32,000 is your pre-earned profit, pre-acquisition profit. And after that, company earned 48,000 where you are into the picture. So 48,000 are also your post profit. We categorize it as a post profit. Post profit will transfer to your profit and loss account. Pre profits are get deducted from your investment to determine whether you have a loss in investment and profit in investment. We'll see later into the picture. So we have total pre and post profit. 32 plus 48, which comes out to be 80,000. This is the check. This will always tally with that reserve and surplus amount. Please remember, this will always tally with that 80,000, because you eventually distributed this into pre and post. You eventually distributed this into pre and post. So this will tally. Okay. Now, the second thing is consolidation adjustment. What are the consolidation adjustment? Consolidation adjustment are those adjustments which are not accounted for in subsidiary books, but holding company wants them to want subsidiary to readjust its figure because of consolidation, like revaluation. Revaluation is not adjusted, but it happened due to consolidation. Like holding and subsidiary buy sale product from each other, it will not get adjusted in standalone financial statement, but due to consolidation, since the group is acting as a whole now, they have to adjust the unrealized profit on the closing stock if earned by subsidiary into their profit and loss. So this is considered as a consolidation adjustment. Even if subsidiary has not accounted any transaction, for example, sometime examination asks bonus. Bonus is bonus issued by subsidiary but not accounted. This will comes into the consolidation adjustment category. Okay. So now you have one point only for consolidation adjustment, which is revaluation reserve. You had made a revaluation reserve of, you have 4 lakh of plant which is gone up by 20%, which comes out to be 80,000. 80,000 will be your revaluation reserve. Since the plant value is gone up, the depreciation is also gone up. So we have to calculate additional depreciation. The rate of depreciation on the plant is given. Oh no rate is given. So we have to calculate. So the opening value is 4 lakh. The closing value is 3,80,000. The amount of depreciation is 20,000. What will the rate of depreciation on 4 lakh? So 20,000 divided by 4 lakh, it's 5%. So 5% is the rate of depreciation which additionally charge on 80,000, which comes out to be 4,000. What will be the correct way to calculate this 4,000? The correct way is always calculate the rate, that the depreciation on the revised value. So now you have a revised value of 4,80,000, 5% of which 4,80,000. 4,80,000 into 5%, it's 24,000. You have a 4%, 5% of 4 lakh is 22,000, 20,000. So additional depreciation is 4,000. Please guys, always calculate in this way. Otherwise, do not go for shortcut. Let's calculate 5% of 80,000. It will give you a wrong answer sometimes. Sometimes it gives you a right answer. Sometimes it gives you a wrong answer. So please always calculate what will the amount of depreciation on revised value less what will be the amount of depreciation on original value. This will be the additional depreciation, which is 4,000. So you add 80,000 into the reserve. You have a now total reserve of 1,12,000, and post profit is 44,000. This will not tally to 80,000. Please remember, you have posted some adjustment which is not into the standalone, so this will not tally. This is the first check. Now we'll also tell you the second check as well. So now you have a profit after consolidation adjustment of pre and post. You calculate cost of control. You take in value of investment that you had invested in the subsidiary. You pay 5,60,000. What you get? You get share capital of 3,60,000. Share capital of 3 lakhs. You pay 5,60,000 and 3,600 share, 100 rupees each. Share capital of 3,60,000. The share of pre-profits is 80%, 1,12,000 into 80%. The ratio is, what is the ratio? 3200 divided by 400, 4000, 80%. I miscalculated it. क्या? 1,12,000 into 0.8. No, sorry, my bad. 3,600 actually here, na. Then 90% would be the 90% would be your stake. Since 90% would be your stake, so 1,12,000 into 0.9 is 1,008,000. So you pay 5,60,000, you get 3,60,000 as a capital, and the share of your profit which is already earned when you are not into picture is 1,008,000. So you have a loss of 99,300. You had somehow paid extra 99,200. So the extra paid is appear as a goodwill in your consolidated financial statement. Second thing you're gonna calculate is minority interest. The share capital of minority interest is 4 lakh less 3,60,000. 40,000. The share of pre-profits are 1,12,000 into 10% is 11,200 and 44,000 into 10% is 4,400. This comes out to be 55,000, 55,600, 55,600. So the check for the minority is there. You're gonna calculate Q limited net asset, which is 4,80,000. Add any consolidation adjustment. You add revaluation reserve, which because it will increase your reserves. You deduct depreciation because it will deduct your reduce your reserve. The net comes out to be 5,56,000. Multiply by minority interest 10%. You will get 55,600. So 55,600 would be your minority interest, which is this. Consolidated reserve and surplus. You took H limited reserve and surplus, which is 2 lakh. H limited reserve and surplus 2 lakh. Add post profit. Add post profit 44,000 into 90%. Add post profit 39,600. So consolidated reserve and surplus would be 2,39,600. So this will be the main items of your consolidation. Rest you have to add and put. Rest you have to add Q limited balance sheet and put this figure into your balance sheet. Your balance sheet get tallied. If you feel doubt, then you can comment. We'll discuss accordingly. No problem at all. Now coming to the next question. On 31st March, 31st of March 24, Delhi branch submit the following trial balance to its head office at Mumbai. You have to prepare trading and profit and loss account for the Delhi branch. It is so simple question. You just anything that is inside the trial balance has a single effect. Anything that is outside the trial balance has a dual effect. So furniture equipment comes into balance sheet, asset side, depreciation into P&L account, salaries into P&L account, rent P&L, advertisement P&L, telephone P&L, sundry office P&L, opening stock trading account, goods received from HO trading account, debtor balance sheet, cash in bank balance sheet, carriage inward trading account, credit balances, outstanding expense liability, goods returned to HO 10. This will get reduced from the goods received from HO account in trading account, sale trading account, head office expense into the balance sheet. Okay, so you have an adjustment. Stock on 31st of March 2024 was valued at 1 lakh 124 lakh. This is the amount of closing stock. Since it is outside the trial balance, it has two effect. Number one, trading account. Number two, balance sheet. On 29th of March 24, the head office dispatched goods costing rupees 20 lakh to its branch. Branch did not receive these goods before 1st of April 24. Hence, the figure of goods received from HO does not include these goods. Okay, so the basic problem is HO sent goods. Branch did not receive. Who is in fault? The branch is in fault. HO did their job now. Branch is in fault. So you have to pass entry in the books of branch. So what entry you pass? Goods in transit to HO. The first entry is goods in transit to HO. Second thing, also, the head office charged branch 2 lakh for centralized service for which the branch has not passed any entry. So the HO gives centralized service. HO booked their expenditure and accordingly, but a branch didn't do anything. Who is in fault? Branch. You have to pass entry in the books of branch. What are the entry that you're gonna pass? Since HO paid expense for the branch, I told you HO and branch are independent person. Your neighbor has paid something for which you had expense for what entry you gonna pass into your books of accounts? You books your expenses and payable to your neighbor. So same entry will branch will pass. Branch will book its expenses centralized bank and to HO as a liability of 2. These two entry has a 2 effect into the trading and balance sheet of HO and uh, of branch. Sorry, these two entry has a 2 effect, GIT and HO centralized into the P&L account and into the HO. So HO is coming as a 16C. Yeah, HO is 16C plus 20 plus 2, 22, 182 plus profit. So it's 182 plus profit. Okay, my camera got hanged, but somehow I fixed it. So I was telling, so these are the two entry that you are gonna pass into your financial statement of branch. The GIT will comes into the balance sheet part. HO will add it to HO of amount of 160. So it will be 180 now. 160 plus 20. Centralized expense will transfer to profit and loss account. HO will be added to HO balances, which is now 182. 160 plus 20 plus 2, 182 now plus profit that you have earned. So let's see the answer. You will get more clarity to it. This is the consolidated balance sheet we had done, considered it so far, no problem at all. So this is the reduction from goods and received from HO. The net profit is 48. HO balance is 160 plus 20 plus 2 plus profit, total 230. GIT will comes into 20. Centralized office expense, this is 2. They charge as a head office expense. You can centralize of, you can mention it as a centralized office expense. There is no problem at all. Okay, let's come to the B part. A Limited acquired 70% equity share of B Limited at 20 per share, face value 10 on 31st of March 24 at a cost of 140. Calculate the amount of share of A Limited and minority in the net asset of B Limited on this date. Also compute goodwill capital reserve on the acquisition of share of B Limited from the following information available. So this is so simple. As I already told you, when you come into picture, what are the position of net asset? That is the scenario. When you come into picture, what is the position of net asset that you have bought? This will get reduced from your investment and you calculate goodwill and capital reserve, because this is so simple. Because you, when you came, this is the position of the company that you bought. So you paid something, that is your investment, and you get something, that is the net asset, share capital plus reserve or asset minus liability, whichever way the answer will be the same. This is the gain or loss or extra or less paid. If you paid extra, it will come into the goodwill category, because somehow you will get the benefit in future because of that acquisition. If you paid less, it is not a profit, it is not an ordinary activity, hence it will get capital, it will shown as a capital reserve. So you have to calculate the net asset. So let's determine the net asset is property plant equipment 360, investment 90. The position of B Limited, 360 plus 90 plus 140 plus 30 minus 180 minus 100 is comes out to be 340. 340 70% is 238. 340 70%, because you acquired 70% at 20 per share. So 238 will be the share of your net asset. Okay. 238, and you pay for 140. So you pay 140, you get 238. So 98 would be your capital reserve. So simple. Following is the trial balance of Amol Limited on 31st of March 24. This is the question from Schedule 3, Companies Act Schedule 3 wala. And you have to prepare consolidated, you have to prepare balance sheet and profit and loss account. So the very first step you're gonna do is you're gonna read the adjustment and mark accordingly whether these adjustment are adjustable adjustment or disclosable adjustment. For example, the authorized share capital is given for disclosure purpose only, so it is a disclosure based adjustment. So for equity you write this D into the trial balance, so that when you prepare the balance sheet, you remember there is an adjustment with respect to disclosure. So when you prepare notes, so you can mention to, suddenly you see the D, and when you while preparing notes, you know there is an adjustment for disclosure, so you can write it down into your notes to accounts. Okay. Another thing is rent of 10,000, wages of 78 to 50 are outstanding on 31st of March 2024. These are the adjustable adjustments. So for rent, you will mention A as an adjustable adjustment. So while preparing balance sheet, when the rent items come, you know that there is an adjustable adjustment. You have to add rental into the into the other expenses part, and shown it as an outstanding rent because of the adjustment given. Okay. So baki rest question is same. There is no is no any there is no problem at all. I believe so. But if you feel doubt, you can ask. There is no problem at all. we'll discuss it, no problem. Meet Limited and Preet Limited were amalgamated on and from 1st of April 24. A new company, Heat Limited, was formed to take over the business of the existing company. The balance sheet of Meet and Preet on 31st of March 24 are given below. So there is a new company that is taking over the two company. First of all, we have to calculate the PC. He Limited will issue 5 equity share of for each equity share of Meat Limited. Meat Limited had 24 lakh equity share. 5 will get, so total number of share will get 5 into 24. One of the student asked for the number of share, so that is why I'm focusing on the number of share issue. So 120 share are issued at a price of 35. So the PC for Meat is 4200. And 4 equity share for Preet. Preet has in 22.5 share outstanding, 4 issue for each. So number of share would be 4 into 22.5. 90 share will be issued to Preet at a price of 35,3150. Since the price is 35, par value is 10. So 25 is your security premium and 10 is your par value. So if you're gonna calculate the number of shares, so you have to multiply 5 into 24 into 10, 1200 share capital to this, excluding security premium. 4 into 22.5 into 10, 900 to this, excluding security premium. For security premium, you have to multiply it by 25. Preference share holder of two company are issued equivalent number of 16% preference share of Heat Limited at a price of 160 per share, face value 100. So number of preference share are 9 into 160. This is the amount of preference share capital issue. Number of share preference share 6 into 160. This is the amount for preference share 960. Now how do I came to preference share number? This is 9 and 6. Okay. Okay, so this is the amount of PC would be 4200 plus 1440, 3150 plus 960. This is the amount of PC that you had paid. For debenture, 10% debenture holder of Meat Limited and Preet Limited are discharged by Heat Limited, issuing such number of its 16% debenture of 100 is so as to maintain the same amount of interest. So what is the amount of interest that currently debenture are enjoying is 10%. So 18 and 9, and you're gonna issue 16%, 18 and 9, and you're gonna issue 16%. This 18 should be equivalent to 16, this 9 should be equivalent to 16. Then how much amount of debenture you have to issue? It's 112.5 and 56.25. Investment allowance reserve will be maintained for 4 years. If it is a purchase, then you have to use amalgamation adjustment reserve. In case of a merger, investment allowance reserve will as it is comes into your balance sheet. Liquidation expense for Meat is 12, Preet is 6. It is decided that this expense will be borne by Heer. So for in case of a merger, liquidation expense will come into goodwill capital reserve category. In case of in case of a purchase, the liquidation expenses comes into goodwill capital reserve category. In case of merger, they will charge the profit and loss account. We have also discussed why this has happened in one of our video of all adjustment of amalgamation in one video. You can watch this as well, and you will get more clarity to that point. All asset and liability are taken over at book value. Now the authorized share capital of 300 lakhs 30 crore divided into equity share of 10 each. After issuing required number of share to the liquidator of Meat and Preet, He Limited issued balance share to public. Okay, they had issued balance share to public. The share price is 35. So how many share they had issued to Meat? To the He Limited issued 5 into 24, 120 share, and 4 into 22.5, 90 share. And you have authorized share capital of 3000 lakhs. 3000 lakhs share capital you have authorized, and your balance share are issued to public. So let us calculate how many share are issued to public. So for Meat, for Preet, and for public. For Meat, there are 1200 share capital issue. How do I calculate 1200? 5 into 24. 5 into 24 or 120 share into 10 each into 10. 1200 share for Meat. For Preet, 4 into 22.5 into 10. For Preet, 900 share, and the balance for the public. Balance for public will comes at 300 lakh share, because 3000 lakhs for क्या कहते हैं for 10 each, तो 300 lakhs are share. You issue 120 to Meat, you issue 90 to Preet, the balance into 10 you issued to public, which comes out to be 900. So total is 3000. For preference share, you issued 9 into 100, 900 to Meet, 6 into 100, 600 to Preet. So total is 1500. Okay. Security premium. Let's calculate the security premium as well. If someone has a doubt on security premium on Meet, Preet, and public. So 5 into 24. Share are 35 each. Now 25. 4 into 22.5 into 25 and 300, or let's say 90 into 25. This is the security premium, and for preference share capital, security premium will be 90 into 60 and 6 into 60. Your security premium amount will get tally accordingly. There would be no problem at all. Okay, so okay, so let's just calculate the goodwill as well. This is the net asset, total asset 600, for debenture amount 112.5 and 50.2.5, and the another remaining liability 1260 and 570. This is the net asset. This is the amount of PC. How do we come to the amount of PC? 4200 plus 1440 is 5640. 4200 plus 1440 is 5640, and 3150 plus 960 is 4110. 4110. This is the amount of goodwill. Total it and you will get 1012.5 plus 236.25, 1248.75, plus you paid 18 lakh. You paid 12 plus 6, 18 lakh as liquidation expense for purchase. It is goodwill plus 18. So goodwill would be 1266.75 into your balance sheet, and that's it. There is rest, the question is easy. I hope you can do it. There is no problem. The only doubt that came to me, for one of the student asked, is how the number of year are calculated. So this is the explanation for number of year. I hope you get it. If you feel any doubt or the explanation feels you didn't clarify your doubt, you can reach me out. We'll discuss it accordingly. There is no problem at all. Question number 6, with regard to the financial statement, name any 5 characteristics. You can write it down. There is no problem. Aman started his business on 1st of April 23, 24 lakh, represented by 1,20,000 unit of rupees 20 each. During the financial year ending 31st of March, he sold entire stock for 30 in order to maintain the capital intact. Calculate the maximum amount which can be withdrawn. So it's very simple. 1,20,000 into 20, 24 lakh of capital he has. Now he sold for 30. He has cash of 36 lakh. To maintain 24 lakh, he can maximum withdraw 12 lakh. There is no problem at all. Another question of trade payable of CAT include amount payable to JBB for rupees 10 lakh regarding a prevailing exchange rate of date of transaction, which is 80. The exchange rate on the balance sheet is 85. You calculate up. You need to calculate the amount of exchange difference. So in dollar term, 10 lakh divided by 80 would be the amount rupee divided by 80, $12,500. Now this dollar comes out to be come up by 85 into 85. You have 10 lakh 62,500. When you borrowed the amount, you're gonna pay 10 lakh, but now at the balance sheet date, amount is 10 lakh 62,500. You have a loss of 62,500. So you book the loss of 62,500. 62,500. You book the loss of 62,500. Rest of the question are theory. You can easily do them. There is no issue challenge into them. I hope this video clarify your as many as doubt. As many students are approaching us for the English video. We tried with the subtitle as well, but it doesn't make any sense. It doesn't give the clarity that I think the student will get. So we'll re-record the session in English only, and I hope it will help you guys out. If you feel any doubt with respect to the any question we have discussed so far, if any point is still confusing you, give a challenge for you, you can reach me out by number, by email, by telegram, by comment, any way deems fit for you. We can talk, we can discuss and resolve your query. There is no problem at all. Let us meet in the next video. Goodbye, tata, take care, good luck, bye bye.